I'm just kind of curious, are we in the middle of a housing bubble building up here?
So yeah, prices have been rising, and nationwide prices have gone up by 16.9% in the past year. Now, Grand Forks is a more stable market, so we don't experience the massive peaks when the market's hot nationwide, and we don't experience the massive drop-offs when the nationwide market.
Welcome, everyone. I'm Dale Coulis, and you are tuning in to the bi-weekly Wednesday edition of the Berkshire Hathaway podcast. And today we have on realtor John Brody. John, welcome to the Wednesday podcast. How are you today with this? Have you been surviving this past week of our nonstop blizzard winter fun?
I know. You know what I've been doing is I haven't even been checking the weather when I leave my house. I'm like, I know it's going to be cold. I don't even want to see how cold it is. I'll walk out and be like, oh, this is cold. I don't even want to know if it's 15 below or 20 below. I spare myself that detail.
Yeah, I've been pretty much in the exact same boat, and I'm just, all right, what are we at today exiting the house? Yeah,
exactly.
It's been relentless. We're getting payback from last year.
We are. Yeah, we are. That's true.
Yes, yeah. So
yeah, I need windows.
Yeah.
I need new windows very badly.
Oh, God. Getting a little gust.
Oh, it just goes right through. Oh, it's like being outside.
That's not good. Yeah. Try this summer, maybe? Some vinyl windows?
Well, it's definitely given me a lot of time to catch up on some movies and shows and stuff like that. The reason to stay indoors a little bit more often. So,
100%.
Yep.
Yeah, 100%.
So are you ready to jump right into it today here?
Yeah. Let's do it.
Yeah, so just to start off with, I'm just kind of curious, are we in the middle of a housing bubble building up here?
So, yeah, prices have been rising, and nationwide prices have gone up by 16.9% in the past year. Now, Grand Forks is a more stable market, so we don't experience the massive peaks when the market's hot nationwide, and we don't experience the massive drop-offs when the nationwide market drops off and goes down. So our market rose about 6.5% last year, and it's been similar. That it rose 6.5% in 2021, rose about right around there, 5 to 6% in 2020. So our market locally isn't rising quite as fast as the national housing market. It's still solid appreciation. Values are going up. Homeowners are benefiting from this. But no, I would say we're not in a housing bubble, mainly due to what's driving the prices right now.
And what would you say would be driving those prices?
So what's driving the prices right now is a very low supply of houses for sale. So, and this doesn't mean that houses aren't selling. Everybody's like, oh, it's impossible to buy a house right now. I don't want to buy a house right now. It's impossible to buy a house. Everything, the minute it lists, it's sold. There's not enough houses for sale. The number of sales actually went up despite the number of listings being way down. So it is possible. More people are buying houses. The main difference that we're seeing is there's not that stale inventory out there of maybe sellers who aren't very serious. What's driving the market right now is a very real issue between supply and demand. Naturally, prices are going to go up when there's not enough supply for the demand that's out there. There's huge demand with the millennial home buyers and a handful of other things. Low interest rates drove the demand. But interest rates and prices aren't always correlated. There's been plenty of times in the past 10 years where interest rates have been rising and prices have been rising at the same time.
And will you say the market, will that go down now that the interest rates are higher?
So that's a really good question. I don't think the housing market prices will drop down, even though interest rates have already risen by about 1% since the beginning of January. I don't think that increase in interest rates is going to cause prices to drop here or nationwide in most markets. The main reason for that is it's not just interest rates that are driving the price up. It's that lack of supply. So in order for prices to go down, you'd have to have just a massive flip-flop of supply and demand in the market. Demand might decrease slightly, but supply is still so far behind demand that even if demand decreases, the lack of supply is going to cause prices to keep going up. And even if demand decreases massively, which it probably isn't going to happen, the lack of supply will cause prices to continue going up, just not quite as fast.
So Just really quickly, I have a question on that because if the supply is kind of low right now, would now be a really good time to consider selling?
Yes. Yep. It's a seller's market. It's probably the hottest seller's market of the year is going to be around April and May. Historically, we have a very seasonal market. That's probably when the strongest time of year to sell is going to be. But yes, if you're looking to sell, it's a great time to sell. Whenever there's low inventory, there's less competition. You're able to get more for your house. You're able to get better terms. You're able to have your pick of which is the best buyer who's offering you the best terms that fit your situation the best. Yes.
But I guess on the flip side of that, though, if you're selling your home, well, then naturally you have to get a new one. So are you going to be ending up paying more for the new one anyway? I mean, is it kind of like a wash?
Yeah, that's an intimidating factor for a lot of people, and that's I think part of the reason that a lot of people are holding off on listing their home, hence leading to the bigger supply shortage. It's not as scary as it sounds because you can accept an offer that's contingent upon you finding and closing on your home of choice. So that gives you a lot of wiggle room. You can push the contract out to give yourself enough time to find a home. You're not going to be able to get a steal on a home, but if prices continue rising, it's not so much about, it's not so much about trying to find a steal right now, because if you're looking for something under market value, you're just not going to find it right now. Your main hope is staying in the market long term and that these price increases continue to happen, and it's going to continue going up with time.
Yeah, I guess kind of bouncing off that, with bringing up the affordability with the prices going up, how are people going to afford housing with these conditions?
Yeah, a lot of times when people look at affordability, they're looking at, 5 years ago I could buy this house for this much, and now it's going to cost this much. Interest rates play a big factor in affordability. Even though interest rates have gone up some, they're still very low, which helps with affordability. But the real thing that most people are missing when they're talking about affordability is you don't want to be comparing past home prices to current home prices. Of course, houses are going to look expensive. You compare house prices in the 80s or 90s to the house prices right now. What you want to compare to is the cost of owning versus the cost of renting. And the benefits of owning, if you're going to be in something for the long term, it's still going to be more cost effective to own even with the higher prices, because we've been experiencing a lot of inflation. So that is pushing rent growth as well. Rents are going up.
Yeah, I know I've definitely experienced that from year to year. Yep. I rent on my end, so yeah, I could definitely relate to that.
100%.
Yep.
Yeah, a lot of people are feeling that.
Yep.
Yeah.
So is this market, would you say it's similar to the 2007 market before the crash happened? Is it kind of starting to maybe look like that?
Yeah, that's another really good question, and we get that a lot, and there's a lot of people who are worried about that because that's kind of in the back of everyone's minds, right? But no, there's some major factors that make it different from the 2007 situation. So if people aren't familiar with the 2007 situation, it was kind of an artificial demand that was driving the prices up. When I say artificial demand, what I mean by that is home buyers that couldn't afford to buy a house were being allowed to buy houses. And that was due to bad lending practices, unsafe lending practices, where the lenders weren't required to verify these buyers' income. So if you walk in, you're a teacher, you're making $50,000 a year, and you want to buy $1 million house, they'd say, not every lender was like this, but they'd say, well, in order to qualify for $1 million house, you'd have to say your income is $300,000 a year. Is your income $300,000 a year? And they'd say, oh, yeah. And they give them a loan. And the other issue was very low equity because people were doing zero down. They were doing less than zero down, where they actually were getting money back to buy houses. So it was an artificial demand that was pumping up the sale prices. Lots of bad lending, low equity. Now you compare that to 2022. The lending process is more stringent than it's ever been. The people who are buying houses are more qualified to be able to afford that house with their financial situation than ever before. Like they will they'll go through your financial situation with a fine-tooth comb, make sure that you can afford this house, because what caused the bubble to burst is when people stopped being able to afford these houses, they had negative equity, and then there's a foreclosure crisis, and all these houses that people end up giving back to the bank all started hitting the market at once.
Wasn't that Fannie Mae?
Yeah, it was government-backed loans. They were I guess, that's a whole nother topic for another time, but they were packaging bad loans in with good loans, and yeah, it wasn't a good situation.
So essentially, way more thorough background checks and balances there, kind of.
Yeah, yep, exactly. And yeah, they just right now they are making sure that you can easily afford that house that you're buying, and you have to put money down now, even though you can get in with low down payments. There's mortgage insurance that also is an extra added layer of security for the banks to make sure people, if people stop paying and goes into foreclosure. So, and right now. So we were talking about equity. When people have a lot of equity, that's a safe situation for the housing market, because that means people can weather a storm and still be able to sell their house, and they're still positive. They still have money that they can pull out of it. When people have zero equity, if the housing market stays flat or drops by the tiniest percentage, they're having to write a massive check to get out of it, and they can't do that. Then they've got to go into short sale or foreclosure or something like that. If they don't have the money to write the check to get out of it. So there's the highest ever equity held by U.S. homeowners right now in America. So U.S. homeowners have more equity than ever before. The demand is real versus kind of an artificial demand back in 2007. More equity than ever now, and more stringent. Buyers are more qualified to purchase the homes that they're purchasing now than ever before. So these are the biggest things that indicate that a 2007 like crash is not coming. And yeah, like I said, increased rates are not enough to slow down price growth. You also need a massive influx of new homes being built and homes hitting the market to keep up with the demand. It's a very different situation than 2007.
Sounds like they got a bunch of learned a lot of lessons from back then to have a bunch of contingency plans in place.
Yeah,
nice.
They learned them the hard way.
Yeah.
This might be a question for another show, but I'm just kind of curious on, two fronts. So, for somebody that is renting, and I've seen people post this, and I've been in this situation before. Mm-hmm. You go to the bank and they, obviously they want money down, and, like, let's say your mortgage payment would be $900, but they're not going to approve you for that loan. So then you're like, okay, well, I guess I'll just go back to paying $1,500 a month for rent.
Oh, yeah.
Yeah. So I guess that would be leading to my question of, this may sound kind of dumb, but for somebody that is stuck in kind of a renting situation, are there sellers out there that do like rent to own?
So yeah, that's something we get asked pretty often. There's not much reason to go with a rent to own over just selling it. The reason for that is interest rates are still low enough where, if you were to do owner financing, basically, or you do an option or something like that, the sellers don't really need to give those type of concessions, and the buyers, it's really not as hard as you think as a buyer to qualify for a loan. If you can afford to pay $1,500 a month in rent, chances are your financial situation allows you to purchase a house. And it could be as simple as making a couple tweaks. Like maybe you've been working towards paying off your student loan debt, but you have a huge car payment that only has $5,000 left on it. Instead of making those large payments towards your student loans, instead make those large payments towards your car payment, eliminate that large car payment, and now you can afford way more house, and you've still been putting the same amount of money towards your debts each month. So that's where you really got to get with a good lender who can tell you what steps you need to take to make it happen. I hope that answers that well enough.
Yeah, that's great advice.
It's a bad situation to be in, but even if you have to get into a little bit lower end house with your first house, it's a situation where now you're in the market. So now those price increases are working in your favor instead of working against you. Before you're in the market, when you're renting, those price increases in rent and the house price increases are working against you because the houses are going farther and farther out of reach, and your rents are making it harder and harder for you to save money. Hopefully you're earning more money as inflation goes up as well, but it's a tough situation to be in. Getting in the market, let's say you get into a starter type home and you live in that for 5 years and the market's gone up, but now you've got a big chunk of equity because you paid off a big chunk of your loan and you've also benefited from the market going up. You paid off, let's say you paid off $15,000 of your loan, you put $10,000 down, and your house has gone up in value by, $15,000. Now you've got a big chunk of equity that you can put as a down payment towards your next property.
Yeah, it sounds just like, building up that credit rating, essentially, right?
Yeah, you do. And that's the other thing that a good lender can help you with is like what little tweaks you can make to your situation to get your credit score where it needs to be. Because if your credit score is on the borderline, it doesn't take that much work on your part. It takes just a little bit of time to get it figured out. But you just need to know what direction you need to be going in so that time works in your favor. Because if you don't know what you need to do to fix your credit, then the time is just passing you by and you're not moving in the right direction.
Yeah, I know that was what helped me personally. Is that I got my first small loan. It was high interest rate, but paid it off within a year. I know that, but from there it led to bigger and better things for credit rating wise.
Yes, yeah, credit rating's super important, and it's good to get on that as early as you can because it just it gives you practice learning how that system works, and once you know how it works, you can make sure your score stays good, and then you're a desirable borrower for the bank.
Absolutely. So is there anything else you have for us today before we wrap up?
No, that's pretty much it. Yeah, if people want to get to know me a little bit better, they can go ahead and follow me on Instagram. I post a ton of real estate content. If you want to become a client, you can reach out to me directly, 701-213-5428. That's my cell phone. A lot of people are planning to make a move here in the springtime, and it's a good idea to get in touch with me early so we can start putting plans in place. So, yeah.
Absolutely. So that'll wrap up your Wednesday Berkshire Hathaway podcast. Many thanks to John Brodeen for coming in, and you'll be here this Friday, correct?
Yes, I will be.
All right. Okay, so we'll be back Friday morning at 10 here with John. We will see you all then.